Hello, good morning and welcome everybody. Thank you very much for joining us on this morning's episode of True Potential's Morning Markets. I'm Matt Henderson and I'm one of the portfolio managers here at True Potential. So if we think back to yesterday and cast our minds back to asset market performance, what we've seen is equity markets be very volatile. So yet to date, volatility's mainly come through fixed income markets given the inflation backdrop and also central bank action. However, equities have remained fairly, the volatility of equities has remained fairly low in comparison to fixed income markets, where actually yesterday we saw a bit of a rotation there with equity markets volatility picking up. So what we saw is the VIX, which is a measure of equity market volatility, moving above 30 and remaining at quite an elevated level yesterday. So what did that actually mean? Well, it meant that equity markets yesterday were weaker. However, what we would caveat that with is that only erases the gains that were made on Wednesday. If we think about fixed income markets, yields moved lower from their year-to-date highs, but the MOVE index, which is something similar to the VIX, lets us look at volatility within fixed income instruments, still remains high and volatile this year. Thinking about currency markets, and obviously we've had a lot of volatility in sterling. We've actually seen a rebound in sterling, so back to 111 versus the US dollar, which takes us around about the level before the UK government announced its latest fiscal plans. Why is that? Well, there's two main key data points that have been released this morning. The first is the revision of the UK GDP data. So that was revised up. So we had been in contraction territory of negative 0.1%, but when the revisions have come through, that's moved higher by 0.3%. So the revision data takes us to positive 0.2 for the quarter. The other main factor, though, however, for the currency is the fiscal balance. And if we think about where that is, it's actually 10 billion higher than the original market expectation. So that supported the currency. The other currency that we have been monitoring and keeping an eye on and have found of interest is the Chinese renminbi. Now, what usually happens with weakness in the Chinese renminbi once again against the United States dollar is that we would see the Chinese government intervene in markets to support the currency. However, this time they've said to markets that they're not going to do that. Why is that? Well, as we've highlighted many times before in these videos, is that the inflation dynamics in China are much different to what we're experiencing in developed economies. So what China are trying to do is, by allowing the currency to depreciate, is to import some of that inflation into the economy to see if they can boost those numbers and get the economy up and running again, given they're still employing that zero COVID policy. That's all from us this morning. Thank you very much, and we'll catch you next week. Thank you.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.